What's up guys? Today I'm going to show you my top 3 high yield dividend ETFs that you can buy here in Australia. Each of these ETFs have at least 10 years worth of consistent dividend payments, have a yield of at least 5% and have really low fees. And it's a great way to add some dividend income to your portfolio without having to pick and choose individual dividend paying companies to invest in. So let's get into the video. Welcome back everyone, my name is Senan and this is Investing IQ. If you're new here, this channel is dedicated to all things investing and personal finance. I cover all aspects of investing from passive investing, dividend investing, value investing and hyper growth investing. We also talk a lot about the greatest investors of our time and how we can emulate their success for ourselves by using their wisdom and their strategies. So if you want to see those videos when they come out, please consider supporting me by subscribing to the channel and smashing that little bell there so you'll get a notification whenever I release future videos. Now we know that dividends are when a company chooses to pay some of its profits out to shareholders rather than reinvest it back into the company for growth. And the dividend yield is the amount you receive per share. For example, if you own one share worth $100 and the dividend is $5, then your dividend yield is 5%. The higher the yield, the bigger the dividend. However, it's important to look out for high yield traps. This is when a company looks attractive based purely on the dividend yield, but the company itself is declining. Let's use our example before with our $100 share. Let's say the company has some bad years, the profits are down year over year and the share price drops from $100 to $50. But they kept their dividend the same as long as possible to keep shareholders happy. Because if they cut their dividend, then investors who invested purely for the dividend will be very unhappy. And they would probably sell their shares and go look for a better company. So if the share price drops to $50 and the dividend stays at $5, now the dividend yield is 10%. Not because the company is actually improving or growing their dividend, but because the share price is dropping. And if this poor performance continues, the company will have no choice but to cut or reduce their dividend. And this is why it's known as a high yield trap. Because beginner investors just purely look at the dividend yield and they don't actually look at the company itself to see if it's growing or declining. And they get stung when the company does cut their dividend payment. And in Australia, this happened with Telstra. If you look at this article from Morningstar, it states that Telstra's stock price had been falling since 2015. However, investors tolerated the poor stock performance on the condition that the company maintained its attractive, fully franked dividend. Dividend yield crept up as the stock price plummeted, peaking at a massive 9% in November 2017. And then in a bid to preserve balance sheet strength and operational flexibility, Telstra was forced to cut its dividend from 30.5 cents per share to 16 cents per share. Literally just cut the payment right in half. Trying to choose which company to invest in for its dividend payment can be tricky and very time consuming. And that's what makes dividend ETFs really attractive to investors who want to take a more passive approach. So instead of you trying to pick and choose your own dividend paying stocks for your portfolio, you just buy an ETF share and let them pick it for you for a low fee. And what they do is they screen for these high yield trap companies and only invest in companies that have dividend stability and are growing. Companies that are improving year over year, have terrific balance sheets and are growing or sustaining their dividend over a long period like 10 years. So let's get into the list. Now this is in no particular order and I chose these ETFs based on their returns over the last 5 to 10 years and their low fees. And each of these ETFs pay their dividends quarterly. Now just to clarify to avoid confusion, because this happened to me when I was a beginner. If the yield is 5%, that means you get 5% per year. You do not get 5% per quarter, unfortunately. So if the payments are quarterly, then hypothetically you'll get 1.25% every quarter. When I was a beginner, I stupidly thought that if you had a dividend yield of 5% and your dividend payments were quarterly, then you'd get 20% yield per year. And I was very sad when I found out that that wasn't the case. So yield is per year, not per payment. Okay, so the first ETF we're going to look at is the Vanguard Australian Shares High Yield ETF, or VHY. This is a very popular ETF for dividend investors as it has very solid long-term returns and really low fees. If we take a look at the long-term returns, it doesn't specify how much of the return is dividends or capital gains on the share price. But if you really wanted, you could work out the yield from how much the payments are versus the share price. But for now, we're just going to look at the overall return. So for 5 years, the ETF's average annual return is 10% per year, and over 10 years is 9.25% per year, which is really good for a dividend ETF. This shows that over a long period of time, they've had a lot of success choosing stable and growing dividend companies. For some reason on their site, they're having technical difficulties and you can't access the holdings, but if you wanted to see what companies are in the top 10, usually you'd go to portfolio and they'd be listed there. And last but not least, if we look at the fees, in typical Vanguard fashion, they charge a really low fee of 0.25% per year. So overall, really solid ETF, high returns and low fees, just as we like it. Next, we have the Russell Investments High Dividend Australian Shares ETF, or RDV. If we go to performance, they have it listed separately for distribution return and growth return. Distribution return is the average dividend return, and growth return is the share price growth. So over 5 years, this ETF's average dividend yield is 5.6% per year, and the average share price appreciation is 2.14% per year, giving us a total average return of 7.77% per year. And if we click on holdings, we can see what the top 10 is in their portfolio. So they have all the big dividend paying Australian companies, the big four banks, Kmart, Telstra and BHP Group. And if we look at their fees, they charge 0.34% per year. So overall, another solid ETF with low fees. The last ETF we're going to look at today is the SPDR Australia Select High Dividend Yield ETF, or SYI. If we go to performance, since 2010 their average dividend yield is 5.5% per year, and the average share price growth is 1.7% per year, giving you a total return of 7.2% per year. If we look at their holdings, they're a little different from RDV, with a lot more holdings on the mining and materials side. And finally, if we look at their fees, they charge 0.35% per year. Another bonus about each of these ETFs is they each offer a different amount of franking credits to Australians, which is basically a tax benefit scheme for investors in Australia. In other countries, when a company generates profits, they pay tax and then they pay their dividends. Then the investor gets taxed on their dividends as income, so the income gets taxed twice. In Australia, there's a cool scheme where companies pay tax on profits and they pass along tax credits to you when they pay you your dividends, so your dividends don't get taxed as income. If you guys want to know more about franked dividends or franking credits, let me know in the comments down below and I'll dedicate a full video to franking for you guys. That's it guys, that's my top 3 Australian high yield dividend ETFs. If you've watched the video this far, thank you so much for watching. If you guys enjoyed the video or if you learned something new, please consider hitting that like button. If you guys want to see more videos like this one, please consider subscribing to the channel and smashing that little bell there. I release videos every fortnight and cover all aspects of stock market investing. So if you want me to cover anything in particular, please let me know in the comments down below. If you guys still aren't satisfied, I have some other passive investing videos that I think you guys will find useful. And if you want to start learning about how to research companies and how to pick your own stocks, I made a full guide where I take you through my research process step by step. So I'll link both of those videos in the description box below. That's it for this video. Thank you so much for watching and I'll see you guys in the next one.